Good morning, everyone. My name is Cornel Ban. I'm an assistant professor in the Department of International Relations. Welcome on a heroic Tuesday morning at 9:30. Amazing turnout for a pretty important question. What changed in the IMF? What didn't? Why and how? The workshop, the two-day workshop we've been having at Boston University, entitled Between Change and Continuity, tried to address these two questions. And yesterday we had a workshop with people who studied the IMF. If I were to summarize, the findings would be that the IMF ended up being something in between a good cop, a Miami Vice cop, and a Star Trek Borg. Pick your choice depending on the policy area. So just to do justice to that kind of assessment, today we're going to have a keynote address from a very important person inside the IMF during a very dramatic crisis that took place in the 1980s and early 1990s. And following the keynote address, we're going to have a few questions from some of the team members from yesterday who will be sitting there. I'm going to introduce each one of them. And following that, we're going to take questions from you all. Our keynote speaker is Professor Michael Dooley, who joined the faculty at the University of California, Santa Cruz in 1992. Following more than 20 years of service at the Board of Governors of the Federal Reserve and the Research Department of the International Monetary Fund. And I would like to stress particularly this position, because this is where the hardcore research in the IMF takes place. His research covers a wide range of issues in open economy macroeconomics, including the Bretton Woods II crisis, crisis in emerging markets, debt management, capital controls, capital flight, and liberalization of financial markets. He's a research associate at the National Bureau of Economics Research, international research fellow at Kiel Institute of World Economics, and edits the prestigious International Journal of Finance and Economics. Professor Dooley's other affiliations have including teaching positions at Bucknell, George Washington, University of Texas, University of Chicago Graduate School of Business, the IMF Institute, the World Bank Economic Development Institute, and the Kiel Institute of World Economics. His consulting positions included stints at the International Monetary Fund, World Bank, and the Federal Reserve Board, and the Bank of Japan. Professor Dooley is also a senior fellow here at our Boston University Center for Finance, Law, and Policy. I would like to express my gratitude and Kevin Gallagher, the co-convener of this workshop, to the Center for Finance, Law, and Policy, and Con Hurley in particular, who have generously funded this event, to Neil Easty and Jaho, who have been instrumental in making this work, to Governance, which is the International Political Economy Review that will publish the results of our research in a special issue. And before I invite Professor Dooley, I would like to invite you to an event on Friday. So if you want to find more about crises and finance and trade, the Party House will have an event hosted by Professor Gallagher on capital controls, where another IMF expert will be present, and a debate will follow up. So lunch, 12 o'clock to 1:30 at the Party House, 67 Bay State Road. Without further ado, Professor Dooley, you have the floor.
With a very nice introduction, thank you, and it's a pleasure to be here and talk to you today. My wife says I've done so many things over the years, eventually I'll find something I'm good at if I keep it up. It's worse. At the IMF, at the Federal Reserve Board, I was an assistant division chief, and then I was an assistant director of the international department. And I was there for about 13 years. Then I went to the IMF, and I was assistant division chief. And then I was an assistant director of the research department. When I left Washington in '92, I promised myself I would never again consider a job that had the word assistant in it. Once you've been an assistant for that long, it's hard to do anything else. But then I went to university. I also worked for a while at Deutsche Bank, and I now run a hedge fund. So I've seen these issues from lots of different points of view. But let's start. The International Monetary Fund that I joined in around 1981. I'm going to give you a little bit of history, not because I want to bore you with history, but because it will help develop the main point I want to make, which is why the IMF and the Europeans are having so much trouble dealing with Cyprus and Greece today. So pretty soon here I'll get into what's happening now. But I think to understand that and the problems that we're having with these countries started a long time ago. Its roots go way back. And they go back in both the history of the IMF and what the fund was established to do and how that's changed over time. So roughly, I assume most of you are not economists. My wife also warned me this morning that I wasn't talking to a bunch of investment bankers. I was talking to students and other people who don't do this for a living. So briefly, you can't understand the politics of the IMF or anything else unless you understand its fundamental mission, or what it was and what it is. When it started after World War II, it had a very clear mission, and that was to be a kind of referee among the industrial countries on their international financial transactions. And the idea was pretty simple, actually, that each country, and the focus was industrial countries, not emerging markets, would throw some money in a pot. And the reason each country was willing to throw some money into this pot was that they knew that coming out of World War II, there would be trade deficits among the industrial countries. And particularly, they knew the US was going to run a surplus for a while, and Europe, which was being reconstructed, they were going to run deficits. What they feared was that a country that was importing more than it exported, that is, running a trade deficit, would be tempted to limit trade, limit imports through tariffs or quantitative measures, or to subsidize exports. And what they were really worried about was a breakdown of international trade. That if you know that in the normal course of things, sometimes some countries are going to import more than they export, they're going to run a trade deficit, and that has to be financed. There were no private capital markets after the war. And so these countries got together, they formed a club, and the rules of that club were that if you needed money to finance imports and you weren't exporting enough to pay for them, you could come to this club, you could borrow a little bit of money from them, and the implicit bargain was that meant you would not restrict trade with your other trading partners. And so the idea was in everybody's interest to cooperate. The US at the time knew that it was going to be the biggest contributor to the pot, because that was the one country that could export. Our factories and farms hadn't been blown up, whereas in Europe they had been blown up. And so the US wanted a fairly tight financing mechanism. And this led to two features of the fund, actually three features of the fund, which are key to understanding what's going on now. First, the IMF had fairly limited resources to lend. That meant that if you were running a trade deficit, you came to the fund to borrow money, they would lend you the money, but it would only be a little bit of money, and you had to pay it back quickly. The reason you had to pay it back quickly is that if you didn't, the next country that got in trouble, there wouldn't be any money for them, and the system would break down. Okay? Now, this was the US, this was the white plan. Keynes, John Maynard Keynes, who was on the other side of this equation, wanted the fund to have lots of money because he knew his country was going to be a borrower. The US prevailed simply because the US had the money. And the US has a dominant position in the fund because they have always been the biggest creditor to the fund. Another part of the deal, which is now almost completely forgotten, is that the country said, look, we're willing to lend you a little bit of money to finance a temporary trade deficit, as long as you promise to put in place policies that reverse that. But we are not willing to lend you money if capital is flying away from your country. So the other reason you get into trouble is not that you're importing too much, but your residents and other people are pulling money out of your country through the capital account. They thought of that as capital flight. They looked at the amount of money they had to finance trade imbalances, and they said, we don't have enough resources to fund capital flows. And so countries were expected to limit private capital flows. Now, particularly in the US, we never did that. But think of it. If you have 10 countries in the world, 9 of them outside the US have complete controls over capital flows, then there's obviously no capital flows from the US either. You're the nth country. It's the N-1 problem. What this meant was that the fund actually required members to limit private capital flows. It's in the Articles of Agreement, still is, as a matter of fact, although nobody pays any attention to it, much attention to it anymore. What happened was the world changed dramatically. This actually worked, by the way. A lot of people think this was a system which was doomed to failure, and it did fail eventually. It actually worked for a long time. Worked pretty well until about the mid-70s. What happened was not designed by anybody. What happened was that private capital markets just developed. There was lots of restrictions on it, lots of discouragement from the central banks. It developed anyway. And by around 1970, I would say the intellectual and even in the IMF, the view changed that, well, maybe private capital flows should be an important part of the system. But believe me, it wasn't any decision. It just happened because it was profitable. In the 70s, I was still at the Federal Reserve Board of Governors and in the international division, so we were watching US banks move overseas and watching a tremendous increase in the volume of transactions, capital flows across borders. The IMF, although they are also a financial intermediary, all right, they take money from one set of governments and lend it to another set of governments. We're sitting over there. The Federal Reserve Board building is about 5 blocks from the IMF. So I'm sitting closer to the river, and they're uptown, closer to the Treasury. So while we are scratching our heads and saying, how are we going to control this system where capital flows are increasing tremendously across borders and had first-order implications for monetary policy, people forgot about the IMF. Who cares about an institution in the 70s that has a couple $1 billion to lend when private capital markets can mobilize hundreds of billions of dollars to finance anything they want to finance, capital flows, trade balances, or whatever? And so during the 70s, as private markets, international capital markets really exploded, the fund just sort of sat there. And the fund staff just sort of sat there. They became irrelevant. People actually talked about, well, maybe we can close the place down. We don't need this anymore. These guys were put in place to lend small amounts of money to countries to finance trade deficits, and both of those things are now irrelevant. First of all, the amount of money around is huge. One bank, one US commercial bank, had more resources than the IMF did. I once heard a corporate treasurer at a meeting at the IMF say, I think he was from Ford, say he was a young guy, about 12 years old, and he listened politely for a day and a half to IMF economists talk about international capital flows, and he says, guys, I do more in a morning than you did last year. So that was kind of shocking to the people at the IMF. So we got to a place where the initial rationale for the fund had pretty much disappeared. The private markets seemed to be functioning very well in the 70s. The fund, I would say, atrophied, both intellectually and as an important institution. In 1981, summer of 1981, the private market evaporated. It simply stopped. The proximate cause was a branch of a Mexican bank. Well, I'll tell the story in more. Okay, so you know what the federal funds market is in New York? It's an overnight market, basically, among the banks. Branches of foreign banks participated in that market as both lenders and borrowers. Mexican banks had branches in New York, and turns out they were borrowing a lot. But nobody kept track of it. So the image I have in my mind is on Friday night, you close the trading room early, everybody goes get drunk, and they're all sitting around getting drunk. Oh boy, I put one over on the Mexicans today. I loaned them $100 million at 4 basis points over the federal funds rate. And the other half-drunk trader says, I did the same thing. I said, I did the same thing. It turned out that the Mexican government was borrowing huge amounts of money overnight because they couldn't roll over their international debt. And that lasted once it hit the street, it lasted about another day. At that point, the private international financial market simply stopped functioning. I was actually, in response to this, being an entrepreneurial sort myself, I saw an opportunity. I could go from the Fed to the IMF because that was going to be, I could tell you the story because that was going to be the institution of the future. The truth is that Paul Volcker was fighting inflation and partially by limiting my salary, which I didn't think was a huge contribution to fighting inflation, but he did. And the IMF would pay me twice as much. So I went to the IMF. Now the problem the IMF has now is that the world has changed dramatically. And you now have the situation where the IMF is not the dominant lender. In fact, it's, in terms of amount of money, it's almost trivial. It increased a little bit, but the situation now is the fund, by 1980, had become a financial intermediary among other financial intermediaries, and not the most important one in terms of money. Important because they were willing to lend when nobody else was, but they weren't the dominant part of the international monetary system anymore. They also had a real personality problem, and that is the international civil servants at the IMF. I can say this, they're all dead. I used to worry about saying things like this, but no, they're all retired or dead or something. Anyway, they considered and I'll put this in, I'll exaggerate a little bit. They considered the bankers, the private bankers, as a bunch of dumbbells who couldn't get into a good school, right? And that was sort of the British/French view of the world. All the smart guys went to École Polytechnique and whatever, and went into the government, and all the dumb guys went to the banking. Now, I had worked at the Fed for 13 years trying to manage these guys, I knew they weren't dumb. In fact, if I had to pick a side, a winner, I would have picked the banks. I still would. But the technique that the fund staff came up with was, we'll manipulate the banks, and so we'll decide what the country should do, right? And what the country should do was, okay, if you're spending too much money and you're not taking enough money in, you should spend less money. Austerity, okay? Well, and austerity actually works. Makes sense. If people are importing too much, or if there's capital flows are flowing out, if you impose enough austerity on them, they'll spend less money. That'll work. And we'll tell the banks what to do. The banks will simply roll over their existing debts. And once we've established that the country is back on an even keel, everything will be all right. Now, a feature of that, which is still around today, which is I'm going to focus on, is that what does it mean to be okay? Or what does it mean for the fund's intervention to be successful? Remember, it used to be that the country would go back on its feet, would correct its trade deficit, would become self-sustaining and continue on through life. Now, there was no way countries could pay back this much debt in a couple of years. And yet, the fund program was only supposed to last for a couple of years, 2 or 3 years. So success meant not that the country actually generated enough money to pay everybody back, but the country could go back into the private market and borrow in order to pay the fund back. Now, that's a subtle thing, but it's important, right? So the fund is in the position of trying to put in place programs which convince the private sector that the country is now creditworthy. The country then returns to the private credit market to borrow and pays the fund back. That's the model we're in. This is a completely different, this is a game now. The fund now is one financial intermediary among many, and not even a very powerful one in terms of amounts of money it has at its disposal. Two really key questions now have to be answered, and I'll now apply this to Cyprus. And they're very simple. I mean, you all, if you've ever loaned any money to anybody or borrowed any money from anybody, you know these lessons. One is, whoa, I fell off the stage. I got to tell you, I got to tell you a story. I once was sitting at a big conference in Spain. Big conference. I mean, it was huge numbers of people, and the stage was up real high, and was on these huge blocks of wood, and the back legs of my chair slipped down a crack, and I went over backwards. I did a full somersault as I was speaking, and I came up on my feet. I was younger and more agile in those days, and I said that was a part of the plan, just get your attention. So that was anyway. So when you're in this is a new situation, and so part of the problem is the fund has never admitted to itself, in my view, that it is now it's now part of this game with the private sector. The fund can't be repaid unless the country regains access. Otherwise, the fund would have this country as a ward forever, and the fund doesn't have the resource to do that. So now, is this a cooperative game? What kind of game is this? When the fund started out in the 1980s, in the first debt crisis that I participated in, the idea was that we really had to not alienate this other big creditor, that is the banks at that time. Because in our program, within 2 years, this country has to go back to them and start borrowing again. And therefore, we can't injure their interests. We can't kill that goose. We've got to be nice to them. And we should be nice to them anyway, because they're sacred contracts, all that kind of baloney. Now, this is a strange point of view for a competitive creditor to have. Coming from the street or from the Federal Reserve, I would say, look, that's not right. It's not your job to protect the interests of the other creditors. You're in competition for them to be repaid. This is not a cooperative game. You've got to, and one of the most important things that you might have to do is to reduce the market value, the contractual value of the existing debt. That does two things to you. One, 2 years later, you have less debt. That's good, right? So you say, well, if we cut the debt by 30%, 40%, 50%, when the country has to go back into the market to borrow to pay me back, it'll have much less debt, and it'll be able to borrow more easily. Trouble with that, of course, is that creditors are going to remember that you dinged them 50%, and so that would make them less likely to lend to you. Right? This is the first great question. when a country like Cyprus approaches the fund, as they did recently, there's a fundamental decision they have to make. If we cut all the existing debt to zero, in 2 years, they would look pretty good, right? In terms of the stock of debt. Debt GDP ratio would look great. And that would facilitate their returning to the market to borrow in order to pay me back. Okay? So initially, if I'm going to make a new loan to somebody who's in trouble, I want them to, in technical terms, screw their existing creditors as much as they can. 100% better, because now my debt looks a lot better. The fund, but I also know if I do that everybody is going to incorporate that into their expectations. And they say, well, if they did it once, they can do it again, right? And so even though they have no debt now, I'm not going to lend to them because I know they're untrustworthy, blah, blah, blah. Now that's a judgment call which people just have not yet faced. People have lots of different opinions about what this trade-off is. And the opinions, unfortunately, between, say, Europe and the United States are much different. Europeans tend to say, go after the existing guys. We don't care about them too much. US tends to say, no, we want to maintain this country's market access or get it back soon, and so we want to be less aggressive. There's just no agreement on that. The second issue you have to make is if you're going to go after, suppose you say, well, look, and this is, if I made a small contribution to this in the 80s, I argued in a series of papers within the fund and outside that there were situations in which there is no feasible set of policies that the country can put in place which will get them out of this without some debt reduction. You're going to have some to make this work. If that's true, that is, the country is literally insolvent. They can't pay everybody. If they can't pay everybody, the next question is who do they pay and who do they not pay? And this is the second question that the fund has, and the official sector in general, has simply never been willing to address. You can imagine that once you're in this situation, every creditor is going to want to be repaid. All right? There's no fair or not fair. Okay? That's a silly concept. It's fair for me, if I'm a creditor, it's fair for me to pay me back. I don't care about anybody else. Now, in a well-functioning debt market, that structure is determined by the seniority of the different claims. And that seniority is enforced by a court. And so everybody ex ante knows who's going to get paid first, who's going to get paid second, who's going to get paid third. Everybody prices their credits according to the risk that they will take. But they know what the game is, and they know because we have 200 years of common law, where courts have decided what kind of seniority to enforce, what kind of seniority not to enforce, and so people know what the game is. Now, once the bankruptcy happens, there's still tremendous amount of self-interested bargaining, right? You bribe the judge if you can, but we know the rules of the game. In international, we don't know there are no rules, right? And so so let's not talk about Cyprus. How much time do I have left there? 5 minutes? 2 minutes? 6 minutes, okay. Cyprus in 6 minutes. Cyprus was an excellent country by all fund criterion through 2011. They grew faster than the other countries in the region. They had pretty much balanced fiscal accounts. They did have a current account deficit, but nothing too serious. But they also had an offshore banking center, which which became huge. Why, you would ask, why would somebody do their banking in Cyprus? Well, pretty simple, actually. They were part of the common currency, and therefore they had their banks had the backing of the ECB and the whole European monetary system. But the local central bank, who was actually run by a friend of mine, a guy I worked with at the Fed, was not very good at watching what they were doing. So if you want to put your money somewhere, say, well, I'd like a nice safe bank. oh, wait a minute, this bank has access to the ECB and the ESF and all this kind of stuff. It's a safe bank. But they're not really watching what I'm doing very much. So if I'm a Russian gangster, that's a good place to put my money. If I'm somewhere else that's in a country which is not a part of the monetary union, that's a good place to put my money. And so their banking system grew to 4 to 5 times GDP. In the U.S., it's less than 1, to give you an example. And another problem, small problem, and actually if you look at the fund literature back in 2010, 2011, they recognized this, they pointed it out, was they loaned most of it to Greece, which didn't turn out to be such a good idea after Greece went belly up 6 months ago. So they had on one side, they have a huge stock of bank deposits, bigger than GDP, owned by Russian mobsters, some of it. Nobody knows how much, actually. Or nobody knows how much is left. They know what it was before it started, but my guess is those guys are gone, but we'll see. They had made loans to Greek residents, 24 billion euros worth of loans to Greek residents, another 6 billion of Greek government bonds. So they had like 3 times GDP in exposure to Greece. Now, a generous valuation of that stuff now is 50%, probably more like 25. So that's a loss of several times GDP. What do you do? Well, clearly, you could use what I call the Irish solution. I'm Irish, so I can do that. The Irish solution was, we'll pay everybody back. We'll tax ourselves to death for 3 generations to pay all you guys back. You say, well, why would they do that? He says, well, they're Irish, they're Catholic, suffering is good. They probably did something wrong and this is God's punishment. Who knows? Okay. Doesn't look like a great solution to most people, although it actually seems to be working for the Irish. They're remarkable people. But you've got this hole. Okay, so the fund comes in. The fund says, oh, I'm going to put how much do you think the fund put into this whole thing? $1 billion. That's like a rounding error that's like a rounding error to the loans just to Greek restaurants, right? And by the way, Cyprus, GDP is about the size of Peoria. Peoria used to be funny. I grew up there. And do you know where Peoria is? What state? Excellent. I used to spend my summers there. Anyway, Peoria is not a huge metropolis. Okay, so we're talking about a tiny country. We're talking about a tiny contribution to this. Question now is, where do we get the rest of the money? We've got a loss. We want to recapitalize these banks. Do we get it from the Europeans? Well, yeah. Europeans, we'll put up 10 billion, I think it was, 10 billion, something like that. Probably not enough, okay? So they go to the president of Cyprus and say, well, you come up with the rest. This guy says, well, what? I don't have any money. I'm the size of Peoria. How can I, where am I going to get tax receipts to do this? So he says, well, I'll tell you what, I'll steal the deposits in the banks. I'll just put a capital levy on all those deposits, and I'll come up with my share of the money from them. And by the way, they're only Russian mobsters anyway. Who cares about those guys? Okay? Well, I got a call in the middle of the night. One of the bad things about running a hedge fund is you get calls in the middle of the night saying that my God, some of the people that we do business with probably have money in Cyprus banks. Are they going to be able to pay us back? And I said, well, no, because the government just stole it. And by the way, if they steal it in Cyprus, why won't they steal it in Spain and Italy and Portugal and everywhere else that's in trouble? The problem is that the arithmetic is clear. When a country suffers a shock like this is a real loss in national wealth. They have this banking system. The assets have declined in value. The liabilities have not. Somebody has to come up with the money. We have no signpost for who that will be. everybody has to guess. This time, they actually threatened the banking system, even small depositors. Right? And the expectation was not completely crazy. I mean, we certainly took a defensive position. We feared that the next day that there would be a run on banks in the rest of the periphery countries. Small probability, but one you take seriously, because that would be a disaster. So what does the fund have to do? The fund, I think, oh, okay. Last point. In each, so the current thing is in each country, people try to look at the country and say, in this country, we should go after the bondholders. In this country, we should go after domestic suppliers. In this country, we should go after Russian oligarchs, right? This is not going to work, right? You've got to have the fund to be an effective institution today has to come to grips with two facts. One, in some cases, somebody is going to have to take a loss. How big that loss is a trade-off between how much that retards access to the future credit and how much it contributes to it. It's an empirical issue. No one knows what the right answer is, but they gotta figure it out, at least come up with a semi-scientific answer. Second thing is you have to have the same seniority structure for everybody. Because if you do it country by country, the private sector is not stupid. They're going to look at a country and they'll say, if there is a restructuring, how will I be treated conditional on what kind of investment I make in that country? And so as a private investor, I will simply look at each country and say, this is where I should hit this country because this is the least likely group of creditors to be murdered. And it'll change over time, and if we don't do something about this, guess why everybody was in deposits in Cyprus? It's because they thought they were protected. Okay? So as everybody runs to and why were they protected? Because going after deposits has long been assumed to be the most damaging thing to a country's reputation. So ex ante, if I'm going to put my money into a country, I'll go into that kind of investment that I think, if it's defaulted upon, will be the most damaging to the country's future prospects. You don't have to be all that smart to realize that the whole structure of capital flows is going to change after every crisis. After every crisis, we get new information about who's going to get killed. And so everybody, the next day, literally, everybody pulls all their money out of that kind of position and puts it in another kind of position, right? So then when the next crisis comes, you got to go with that position, and we go from this. And this is really inefficient because we have the distortion of the form of capital flows in the first place, and then we have a long, bitter dispute about who is going to bear the loss. Final point. Where do I go as a private investor? I go to where a subsequent default on that position will do the most damage to the country. That's my protection. It's a way, think about it. You're gonna lend to somebody, you know there's some probability that they won't be able to pay everybody back. You want them to pay you back. How do you best protect, how do you best make sure they pay you back? You make sure you go into that country in a form where default on that credit does them the most harm, because that's the one they're going to pick last. At the limit, everybody ends up in the same position, and we have no way to resolve the problem. So the IMF is going to have to, or the IMF or the official sector is going to have to come up with much better views on two things. When do you need to cut the existing private debt, and by how much, and what's the trade-off, and who are you going to go after? And once you make those decisions, you got to stick to them. Thanks.
Thank you very much, Professor Dooley. We'll now pass the floor to our panelists. Andre Broom from University of Warwick has long written on the IMF and its ideas. Aitor Erte from researchers at the Bank of Spain to become a mechanic of the Euro engines, let's put it this way. working in Luxembourg for the European Stability Mechanism, and then Grigore Popelekes from Princeton University. His research has been dedicated to basically looking at how the IMF works on the ground in specific countries. You have the floor.
Thank you. Professor Dooley, from your...
You can ask me questions?
Yes.
Oh,
yes.
Oh, good, okay.
From your talk...
I thought you were going to ask Hurley questions. No, okay, sorry,
as
go
well.
ahead. Okay.
From your experience of the fund and your current role as managing a hedge fund, what would be the size of the IMF's financial resources that they would have to get to be effective as a financial intermediary on its own, would you estimate?
It's completely out of, it would be trillions of dollars. It's completely off the table, right? So if I actually knew the fund would, okay, so imagine a situation where a country is vulnerable, has had some serious shock, and I think that there might have to be some restructuring, right? It's a big loss. Literally, the fund would have to replace not just the international positions, say bond positions, but the whole banking system, right? So what we've learned in the last, 30 years is that the real quantitative problem is that when the residents of a country decide that they are no longer safe, then we can now move a banking system overnight. I mean, within Europe, it's quite remarkable. You could wake up in the morning and have the entire, well, in Cyprus, for example, they have frozen the banking system, right? You can't take your money out, or you can take it out only in little dribs and drabs. If that was not in place right now, if that capital control was not in place right now, I would guess the entire banking system would disappear literally overnight, would move to another country. Now, the IMF could come in and become the banking system, but now we're talking huge amounts of money. So it's not a practical alternative. The fund's window of opportunity here is to finance for short periods of time, right, when no one else will, right, to keep the thing going. But that's intimately, therefore, right, they're intimately entwined with both the domestic banking system and the international financial system, right? They're a part of it, and they really need to start thinking that way. There is no way that that Cyprus is going to become a ward of the ECB or of the IMF.
I was curious. Can you hear me?
Yeah.
Because you were talking about the politics of debt renegotiations and so on, and I wanted to ask you about during a period when you were at the fund, during the Latin American crisis, there was the so-called Cartagena group, right, of Latin American debtors that tried to create a debtors cartel to negotiate with the banks. Mm-hmm. And so I was wondering, and that ultimately didn't come about, or at least it came about in a much diminished form, because unilateral agreements were adopted with Mexico and Brazil and so on. And I was wondering what the lessons of that would be for something like the European situation now, and whether, because you're just talking about the problem of having case-by-case decisions.
Right.
And this, I mean, something along these lines of getting everybody to the table, what has changed since Cartagena? Because at the time, obviously, the IMF didn't think it was a good idea.
Well, my memory of that is actually pretty vivid, because I was running around the world to all these different countries. That I was a technical advisor on all of the workouts, and the problem was that virtually every country you went to wanted to have nothing to do with any of the other debtor countries, because they thought they were better, especially the Mexico, right? The Banco de Mexico no more wanted to be associated with the Argentines than they, that was a non-starter. Okay, so the idea that these guys could sort of agree among themselves to present a united front against the creditors, that had no support within the debtors, right? It wasn't so much the IMF; we didn't care. I mean, they could have got together if they wanted to, but even in any gang, there's somebody who's worse off than everybody else, right? Nobody wants to be associated with them.
interesting talk. I have one question and then one comment that it relates to what I will be doing in the coming months and how you see it. So the question has to do with this. I mean, this idea that this case-by-case approach probably is not the right one. So my understanding is that, this was the way that the fund wanted to work because it was providing it with flexibility to adjust or to tailor the different programs to specific circumstances. So I don't know how you value this trade-off, no? Because if I understood you correctly, yeah. So you are arguing, and I think that Patrick Bolton has been arguing this also for a long time, no? That there should be like some solid seniority that is being attached to whatever the creditors of a sovereign are, yeah? But one can easily think of situations in which, despite this is efficient ex ante, it won't be so exposed. So how you sort of handle that?
Yeah, that's a great question. It is at the heart of I think a lot of our problems, and but I think what that argument misses is that the case-by-case approach is also not efficient ex post, because it simply increases people's estimates about what the seniority is there, right? There is a system. You could say everybody will be taxed exactly 3%, right? Just even across the board. Well, we know that's probably not efficient, right? So in any debt workout, and I think you want to look at the national debt, within countries, the debt workout. We set rules which are not necessarily efficient. Whoever made up the rules about the hierarchy of bonds and equities and things like that, you could probably change it, and it probably wouldn't make any difference as far as economic efficiency goes. But the fact is you don't want to change it because ex ante everybody's priced their contribution to the financing of the country according to this perceived seniority thing. Well, if you then change your mind and say, suppose we had 50 different courts in the U.S. and they all had a different view as to who was senior and who was not. Well, you get people shopping for courts, right? You get a lot more bargaining, right? It's much more difficult to actually come to anything. So I think virtually any system of seniority would be better than what we got now, right? I don't have this high bar of efficiency. I'd say, look, you pay off these guys first, and then when they're paid off, you pay these guys second, and when they're paid off, you do these guys third, and fourth, and fifth, and sixth, and seventh, and eighth. And maybe you have to get down to big deposits in commercial banks at some point, right? If there's literally nobody else left, then you go after them. And then maybe you go after $100,000 or less, right? But what you don't do is on a Friday night, you don't let the president of a country decide that seniority, because that creates chaos, right? And that can't be an efficient solution. So I think virtually any system where we would establish. Now the other idea, which some of you might know about, is that there was a proposal in the late 80s that the IMF should be the arbiter, the final judge, right, of this, binding judge. And that was a non-starter too. You're not going to give the fund arbitrary power to do that, right? So it's got to be established beforehand. If I know the rules of the game, then I know that if I have a certain kind of credit to a country and they receive a certain level of shock, I'm going to get hurt. I charge them for that up front. That's fine. I don't have any problem with that. I have a big problem if I take a position which I think has always been protected, and now in this case by case, it's not going to be protected. Then I'm going to argue forever, and it's going to be very inefficient, very messy solution.
You want to follow up with that?
Yeah. I wanted to have your opinion on, as I said, like something related but a different issue. Yeah. So from what you have been telling us, there is this point in which what is really important in order to figure out what to do with countries, to get to see if the country is insolvent or is illiquid. Pretty hard to find where the difference is. Yeah. But still, I'm thinking in terms of like the operational framework in which the European Stability Mechanism, which would be like a form of European Monetary Fund is going to be operating. Yeah. So for the ESM, there is going to be a clear attempt to look at this. So the first thing that the country is going to receive whenever they are asking for support is a debt sustainability analysis on the lines of the IMF. To the extent that this debt sustainability analysis is showing that the country is hardly sustainable, in order to get official support, the country has to go through some debt restructuring, private sector involvement kind of thing. Which, I mean, I don't know how you see this, no? But indeed, this is trying to tackle one or two of these questions that you posed.
Right. Okay, so my approach to that is as follows. I've done 100,000 debt sustainability projections. I've done them. I was hired by the Argentines to do it for them. I was hired by the IMF to do it for them. I was hired by Deutsche Bank to do it for them. What answer do you want? Okay. You're right. It was, and I assume the guy on the other side of the table is getting paid to do the same thing, right? So, in fact, in Argentina, we always use the same table, the same place in the finance ministry. And one of the times I walked in and sat down, and the guy from the government said, "No, you're over here." I said, "No, I'm on this side. I'm on the bank side this time." Anyway, okay, but I think that's a problem. But you can negotiate that, right? People have different interests, right? So you can get. My experience is everybody comes in with their debt sustainability simulations, and you bargain. I mean, you negotiate. Okay, here's one we can agree to, right? And that implies that we need some. Suppose it does. That requires some debt reduction. The next step, however, is to say, well, okay, that the amount of debt reduction which is optimal depends on how long you are willing to lend to me. If you're willing to lend to me for 10 years, well, then I don't have to adjust very fast. I can have a nice, slow adjustment path with not much of a loss in GDP, right? If you're willing to come up with that much money to support me. If you're not, okay, and you're going to cut me off after 2 years, and I'm going to get thrown back into the market because I got to pay you back, now I need a much more draconian program. Okay? Now that is the judgment which we refuse to make explicitly, right? And people come with all kinds of what seem to me, secondary issues like moral hazard and stuff like that. I mean, it's all great, but the fact is that if I have to come back to the market in 10 years, and this is what I actually think happened in Greece, I can afford to be much tougher on my private creditors, right? So if you look at it's very instructive. You look at the fund program, I think it was the September before the crisis. It was a typical fund program where there was just a mild hit on the private creditors, and they regained market access in 2 years, at least according to the program. It's all made up, of course. The actual program that was put in place hit the private sector much harder, and it's recognized that they're not going to get back to the market for 10 years. Okay, so the official sector, that's the trade-off. Okay, so now there's not even any scientific basis for that judgment, right? I don't have any idea whether if I take another $1 billion out of the private sector, if that speeds their reentry because they're now in better shape, or does that retard their reentry because they've been shown to be deadbeats? You would think that partial derivative would be on everybody's agenda. As far as I can see, it's on no one's, right? And so at the last minute, you get politicians making these decisions based on what seems to me no guess as to what it is. At least if we started making guesses, we could compare it to what actually happened and see whether we're right or not.
Thank you very much. It is now time to turn the tables on the floor. If you have any questions from our Professor Dooley or the panelists, feel free to raise your hand.
Well, we're generally very clear, but not that clear.
Please.
Hi.
Thank you, first of all. I just have a question back to this idea of seniority. How do you suggest? Oh, sorry. How do you suggest the seniority is established? Is it going to be through courts or through like IMF bylaws? And second of all, how do you enforce seniority? Like, especially if you have a leader who's invested in maintaining sovereignty, how then do you enforce that this seniority is followed through each case?
Sure, it's a good question. I mean, you can't. There is no. I don't think there will ever be an enforcement mechanism, a real one. Okay, the best you could do is to say that the IMF, when we go in to support a program, and when we have reached a judgment where some private sector involvement is required, this is the seniority structure that we will support. You just don't leave it up to the country, right? Now you're absolutely right. It's a great point that this is what I meant by self-interested bargaining. Suppose I'm on that list to be hung. Well, I'm not going to say, okay, yes, I deserve it. I loan the money, I deserve it, I should be hung. I'll say, no, everybody else should be hung, not me. Okay, so I may be a holdout. Okay, we have all those problems, all those. One of the things you want to remember about international debt is it doesn't go away, right? So if you don't pay somebody, they don't say, oh darn, you don't owe me the money anymore. They keep the contract. They keep adding interest to it. You know, the holdouts in Argentina are still. I'm an Argentine holdout, actually. I'm still around. I hope someday they'll pay me. But I think that that's a problem which we can't deal with. That's why the SDRM or whatever it was called was overreaching. It wanted to enforce it. That's not going to happen. But it would still be useful to have it there so that at least we know how the fund is going to, what kind of support the fund, what kind of program the fund is going to support and what they're not going to support. Making it a case-by-case basis is a disaster.
More questions?
Hi. So, like, when it was founded, it was all Europeans running the show, but now, you know, the BRICS countries are becoming more influential and richer. So how is that changing the game, and would that change the long-term versus short-term funding?
I'm sorry, I missed the first part. What?
Well, just because when the IMF was founded, it was all just Europeans putting
right.
money in. So with the BRICS becoming richer and, you know, trying to get more influence in the IMF, how is that changing the game?
I don't think it does. See, my view, I have a kind of a hardcore view of what the IMF is. And it's a financial intermediary. It takes money from one bunch of people and it lends it to another. Now, if what the fund does is very far, or even slightly far away from what those two governments could do bilaterally, then the fund will lose their place in the game. So the power structure in the IMF is, in my view, is a right-wing view, identical to the power structure in the world. Right? It's because it's no accident that the U.S. Treasury is 3 blocks from the IMF building. It's no accident that when a country comes to borrow or get a program from the IMF, they don't come to the IMF first, they go to the Treasury first. And then they come to the IMF. And if the fund tries to lend on terms even slightly differently than what the two governments could do bilaterally, it'll simply be taken out of the equation. So the voting is, I mean, I understand, and the reason I hesitate a little bit, I understand a lot of people study the voting patterns and things like that. That's great, and it's important. But I don't think it's important because, sorry guys, I don't think it's important because I can go around the IMF. The IMF you know, if there's a thing in a program which I don't like, then I go to this, either the creditor or the debtor, either the creditor country will like it. There are other channels, let's put it that way. So the IMF as an independent institution, it's like Chase Manhattan Bank. You go to get a mortgage and they say, well, nope, our policy is that you need 40% down payment. You say, well, hell with you, I'll go to another. I'll go across the street. Well, across the street here there are huge bilateral relationships among all these countries, right? So the IMF staff says, you know, you're going to do it this way, blah, blah, blah. So if there's confusion at the IMF, it's because there's confusion in the national markets. And subtle changes in the organization of the IMF, I don't think are first order.
So you don't think the tides are going to turn, like, with these countries becoming more, like, stronger GDPs and with Europe going down?
Well, no, look, don't push it too far. The BRICS becoming important and becoming financially independent and powerful is an important change in the world economy, in this power structure. The fund will reflect that. It won't, right? It'll just, if Brazil is if Brazil is an important country, it's an important country. It's not because the IMF thinks it is.
For now, sorry, maybe we could also add a little bit to that.
Sure.
Yeah, I mean, if you think about non-borrowing countries from the IMF, like the case of China, which has become a big bilateral creditor to the IMF in recent years, you could see this as buying de facto veto power, to the extent that the Chinese government does not want to be labeled a currency manipulator by the IMF. It's a different side of what the IMF does in the world compared to its financial intermediary role. But for many governments, this is important, not to be externally criticized, even if that doesn't have direct material consequences. So I think you could potentially see that in the case of China, perhaps more than the other BRICS, as buying a de facto, or trying to buy a de facto veto power over policy decisions and how the IMF operates for non-borrowers in terms of surveillance that doesn't like. Would that be Google?
Yeah. I mean, fair enough. And again, this is not just about the individual countries' quotas, but how they can get together or not, right? That's. I mean, de facto, as long as you get over the 18%, you can have the veto. But the U.S. is the only country that can do it by itself. But coalitions of countries can do that as well. So,
yeah.
So in a sense, what's new is more the BRIC cooperation than the actual, vote shares of the BRICS.
So this is returning a bit to the idea of seniority and trying to enforce some kind of agreement ex ante. Is there any appetite for the IMF to come up with some sort of international agreement where if ex ante we set up a seniority structure that you agree as a recipient of funds to enforce should you need to receive funds from the IMF? And that the IMF will then sort of oversee that seniority in the event of some sort of lending or crisis, and that the IMF's power in that sense is that they are the lender of last resort. So the private markets have dried up for these countries. They now turn to the IMF, and they've agreed with the IMF. For the privilege of being able to take your funds, I'll agree to obey your seniority. And then the final follow-on to that is, do the private markets actually want this, or do they enjoy the ability to negotiate and sort of arbitrage in a way that the inefficiency of the pricing of the seniority is an opportunity more than inefficiency?
I love the last part of the question. I think what most people would say would be that they would rather there be some best practice or some guidelines to limit the really crazy solutions that governments come up with in the 11th hour. Okay, the first part of the question is also interesting. Would the debtor countries be willing to sort of sign up for, say, okay, this is the way, in the event of trouble, this is what we're going to do? I doubt it, frankly, because they would, first of all, they would be admitting that they might do such a thing, which they will never want to admit, ex ante. So I don't know. My proposal is that, or my view, I guess, is the more enforcement, either ex ante or ex post, you try to put on this, the much less likely to happen. No one wants to commit. People might want to commit themselves to, this is what I will do in extremis, but it would be better if the fund said, this is what we think you should do, in my view, not what you're required to do. I don't think it'll happen if we do, you know.
If I could add a point there, my view, I guess that Professor Dooley won't agree with me, or I don't know, let's see, is that the fund is already imposing a kind of seniority with the programs. So the conditionality that is attached to the programs, that in my view gives a higher protection to external creditors. The fact that some conditions that may affect the involvement of the domestic sector may be fulfilled or not, and if fulfilled or not, may be waived or not by the institution in order to keep providing official funding. All this structure of conditionality has an implicit seniority, an implicit pecking order, in which I believe that foreign investors are placed before domestic banks, which are placed before domestic suppliers. But I don't know if this is something that Professor Dooley would agree with.
Well, it depends on what you mean by it. If once a program is agreed, then the seniority, that enforcement will be a part of the program, right? That's certainly true, right? I think the problem is the fund has too little to do with that, not too much. It has too little to do with it in the sense that it says, comes to the government, came to the Greeks or the Cypriots and said, you need to come up with $6 billion. Now this is, by the way, this is an old fund tradition. That's what they've always done. So in the old days, where you needed to either raise more taxes or cut government expenditures, they would go to the finance minister. I've done this myself and said, I need $4 billion. If you want to tax widows and orphans, that's your business. Now then there's riots in the street, and I'm a bad guy. I think that in this case, the fund should be more proactive, actually. And so what your description, I think, is accurate, but I don't think it's the fund's preferences. I think it's the government's preferences, right? And so, yeah, we want to get a little bit more uniform treatment. Remember, in all of this, my assumption is that there is no such thing as an more or less efficient way to allocate an existing loss. Right? Once it's there, somebody's got to take it. Okay, and they're not going to like it. If they can injure you, so I did a paper I mentioned earlier that with you is that did a paper in the 80s called Endogenous Creditor Seniority, where everybody ex ante positions themselves so that everybody else will take the hit, right? And that's a game. And I love your question. Yes, that's a game which we enjoy. Sorry, that's a game that we like a whole lot, right? But it's not, but that's me trying to get at the bankers, at my fellow private sector guys. It's not me, right? I mean, I'm competing on that. A good banker, by the way, some of you may become bankers. A good banker is not someone who makes good loans. A good banker is the guy who gets paid back before everybody else does when they make a bad loan. That's the difference between a successful financial guy and an unsuccessful financial guy. Nobody knows who's going. Everybody knows a certain percentage of people are going to default. What we don't know is who they are, right? But that doesn't matter either if I get there first and get paid, or I have collateral claim, or I have some sort of enforceable seniority. That's the game. That's what a banker does. That's why when the IMF, in the early 80s, the IMF staff, they thought they'd go up against the bankers and beat them in this game. I said, oh, this is bad. This is trouble, because you guys or think you can beat these guys at what they do for a living. Not going to happen, and it didn't.
Thank you all very much. Thank you to our keynote speaker and our panelists. If you'd like to follow up, the Center for Law, Policy and Finance will have a few podcasts featuring some of our presenters, as well as a short summary of the findings of our workshop yesterday. Thank you all very much. Have a lovely day.